Welcome everyone to our DSCR class. If you're not sure what that is, Jared's going to tell you all about it. So for those of you that don't know Jared yet, he's a CPA, a mortgage professional, a husband, and a dad of five. So clearly managing a lot at once is his kind of specialty. He's incredibly smart, ridiculously good at what he does, and somehow still one of the most approachable people you'll ever work with. Today, he'll break down the DSCR loans for us and make them sound a lot more simple than they actually are. Go for it, Jared.
Okay. All right. Let me share my screen here. Um, let's see. Screen two, share. And then Abby, if you can switch over the thing if you haven't done so already. Um, so we'll just hop right in here. So you should be able to see me and then the slideshow deck that I'm sharing here. So we're going to hop right in the DSCR program. DSCR essentially just stands for debt service coverage ratio. Can be a good option that has some pros and cons, just like any program out there. They come with pros and they come with cons, ideal things and not so ideal things that they're trying to accomplish. So we'll dive right into going through all of that here. So what is DSCR? A DSCR loan evaluates the property income rather than personal earnings. So what that means is that it's going to look at the home and whether or not that home can cover the mortgage on that property, rather than looking at that individual borrower's income to support that mortgage payment. So it's a little different way of looking at it, which opens up some opportunities for a few different reasons that we'll get into. Let me move this little thing somewhere else. There we go. Okay. So how does the DSCR work? So again, DSCR stands for debt service coverage ratio, and a DSCR ratio greater than one means positive cash flow. So if you think about the ratio itself, the ratio is you take all of the income, the expected rental income from that property. Let's say it's a fourplex, so there's four units, and each unit generates income. So you add up all that income and you divide it by whatever that mortgage payment is going to be. So the entire mortgage payment, you do principal and interest, property taxes, insurance, HOA, all that stuff, right? So you add that, you combine that, or you compare that ratio. And if that's greater than one or greater, that means that the income that is generating is sufficient to cover that mortgage payment. If it's less than that, then that's pretty straightforward as well. That is not quite sufficient. So, what are some benefits of DSCR loans? They can be really good. So you probably don't know this because I mean, it just depends on the type of people that you work with. But if you work with someone who's got a pretty big portfolio already, they could have already reached this cap. But there is technically a cap, whether it be Fannie Freddie, of 10 um, finance properties. So if you're trying to get above 10, they're not going to be interested in being there to facilitate that extra one. But DSCR loans allow you to get up to possibly 20 finance properties. So it can be good for those people that are just avid real estate investors that are just adding to their portfolio and need to get up and above that 10. It can also be good for those individuals that don't necessarily have the cleanest of income to document for uh, regular financing through Fannie or Freddie. And when I say clean, I don't mean like bad income. I just mean maybe their tax returns don't adequately show it. Maybe they're self-employed and it's a little bit hairy with the deductions they take and the actual bottom line income that we're using and adding back only the other things, and it's not quite sufficient. So it could be good for those people. You can technically get it closed in the name of an LLC, which can be great for some people. Some people love that option. And then, like again, where I mentioned great for self-employed. It's also on the no tax return side. It can be great from the vantage point of not having to dig through, like, let's say you do have a little bit of a portfolio you're trying to manage and you can kind of take that on or whatever. But this way is a little bit easier with how they calculate the income from that property rather than the Schedule E and all of that. So we'll get into that as well. So some cons to consider. So I don't know if you've been on any of my classes where I'm talking about mortgage programs, But I think I do have to always reiterate that it is a give and take. Obviously, from people in my position or just loan originators or even mortgage companies, they try to be really good at marketing, right? And they try to garner interest in different products or programs based on the benefits that those things um, might provide. But they are not, no lender is in the business of losing money, and no lender is in the business of any too good to be true type stuff. And so in this instance, when you have a DSCR loan that is giving you a different way, a more flexible way of being able to buy an investment property, and that flexibility comes in how they are going to calculate the income to offset that payment. So if you have that situation, there's extra risk for that investor, for that lender, for doing that loan, right? Because the more detailed dive into every complexity of your life is the safer route to go, right? Because you're more likely to spot something that could be problematic the deeper that you dig. So if you're gauging that back a couple notches and you're taking a DSCR loan where it's not necessarily digging so deep into some other areas, there's greater risk that it poses to that investor that, maybe it doesn't work out, or maybe the payments don't get made, or maybe their financial situation isn't good enough, whatever. And so the way that they compensate, or the way they try and balance out that risk, um, is generally just to charge higher interest rates. There's a couple other ways too, but one of the main things is going to charge a higher rate. So you would expect on a DSCR loan that the rate is going to be higher than if you do get a loan to Fannie Freddie, and you're going that route. Minimum debt service coverage ratio. So obviously, it has to, ideally, that ratio is going to be one or greater. And again, what that means is that the rental income from that property is equal to or greater than whatever that mortgage payment on that property is. If you start to fall below that, it doesn't mean that you can't get qualified, but there's going to be probably higher rates. And again, some other compensating factors as well, because it's not just rates. Sometimes it could be that maybe regularly you needed to have 3 months of reserves, but because that ratio fell where it is, now you need 6 months. Maybe you need 9 months of reserves. Maybe you need to be able to put more money down, right? So more skin in the game. So there's other factors that get tweaked around where you're getting flexibility on the income side, but maybe you're losing a little bit of that flexibility on how much cash you need to bring to the table or be able to show that you have in case that rainy day ever does show up. They're looking for rent ready properties. So they're not looking for you to get a loan on a property that also needs a huge overhaul to even be able to be rented to begin with. And then sometimes there can be prepayment penalties, which is just a penalty, a fee that might be incurred if you pay off that loan earlier than whatever the designated prepayment time frame is. Maybe it's 3 years, maybe it's 7 years, maybe it's 5 years, and whatever that time frame is. That if you chose to pay off that entire balance early, you might get hit with a fee. So sometimes these loans come with those as well. So we'll run through some quick facts because one thing I want to make very clear is we don't expect in these blitz classes that we do that you guys come away as like knowing everything about it. But there's some quick facts and some quick pointers that I think generally help you to notice what your clients are saying and then maybe help them understand there may be an option. Because sometimes what they say to you, they might be a little bit more open, or it might be in that early stage where they're feeling a little disappointed because they're like, they know maybe they've been through the process before trying to get qualified and their income just isn't sufficient, but they're trying to buy this duplex as an investment property. And they might be talking to you thinking like, oh man, yeah, we'd really like that. But, and then it can kind of get the wheels turning. You might be the one to be able to give them a little bit more guidance to get them to reach out to a lender to be able to start looking into DSCR loans, start looking into bank statement loans as a different class that we taught, to be able to see are there opportunities here that would make sense that still are beneficial for what they're trying to do. So some of these quick facts would include, so the DSCR ratio, generally the lowest you're going to go is 0.75. Now, again, there's different things you have to have when you're starting to go that low, and it's not every case, right? So this is just kind of a little roadmap to kind of feel it out. but you definitely don't get approved just because it's 0.75 or greater. So you can be a first-time investor, but you cannot be a first-time home buyer altogether. So the first time buying a home, they're not going to be down with that. But if you are a first-time investor, they're okay with it. They can handle short-term rentals. So if this was like an Airbnb, they have a whole like behind the scenes, I think it's like Air DNA or something like that, where they try and calculate what those the projected income on that property would be. So some gift funds in some instances can be allowed to help out. You can invest in your personal name or an LLC. You can go up to 80% LTV on a purchase, and then up to 75% LTV for cash out refinances. So in other words, you would need between 20 and 25% down, depending on the type of the purpose for that loan. The loan amount can get up to $2 million, so they're not going to do more than that. Asset seasoning is about a month. What that means is, if you guys aren't familiar with asset seasoning, so if you were going like a regular Fannie Freddie conventional purchase, primary residence, whatever, they're going to grab the most recent 2 months of someone's bank statements. And they're doing that because they're going to look at the bank statements and they're going to try and identify like how much assets does this person have available to try to do what they're trying to do, which is to buy a home. And then, taking a look at the deposits into that account, the withdrawals out of that account, withdrawals to see if there's any other debts that they're missing, right? That aren't showing up on a credit report that they need to factor in that are super important, or any deposits that are super large that they need to try and get an explanation for, right? Where did this come from? And there's lots of reasons why this takes place. One of the most well-known one, or I guess the most uh, extreme, I guess maybe one would be like money laundering. There's a ton of fraud in the mortgage world. And so this is one way they try to combat that one, but it's not the only reason that they're getting bank statements. But with the DSCR loans, generally you only need to provide 1 month bank statement. That's true as well. It's not like super unique because that's true for like VA loans, FHA loans as well. Minimum credit score of 660, and then again, maximum finance properties of about 20 of them. So it is, again, quickly a potential good fit for those people that are self-employed, 1099. Maybe they have tricky income and they just can't seem to be able to buy one of these properties without a little extra help. So DSCR could be one great for investment properties. Bank statement loan could be another one that's good for, I mean, truly, you could do it for anything, but certainly primary residences if your income is tricky. If you've exceeded that 10 finance property limit, it could be a good option. And then in some instances, if you are restricted on the purchase price due to regular mortgage restrictions. So it can be a good fit. I don't think it's anybody's first option necessarily, depending on what that goal is, right? Obviously, one of the most important thing for people when they're trying to do anything with respect to mortgages or financing is to try to get the best rate that they can. But if you can't buy the home, it doesn't matter what the rate is, right? So if you're trying to get Fannie Freddie and you're like, oh my gosh, through this financing it's 7.125, but I can't even qualify for it, then it doesn't matter that it's 7.125. If the best thing that you can qualify for is maybe a DSCR loan that is 8.25 or something, then that is the new best, right? That is the new benchmark because the other one's not even an option. Um, so what I want to do right now is just kind of go through a real world example really quickly so you can kind of see the differences between the two from the lens of a lender looking at it, right? So on the left side of this, what you'll see is a regular investment purchase. So the left column, regular investment purchase of a fourplex. The right column is going to illustrate a DSCR investment purchase. So I'm going to run through the left column first and just highlight what it's breaking out here. So we have a purchase price and loan amount. Both of those are the same thing in both columns. Interest rate, you'll see that 7.125 on the regular investment. And this is not reflective of where interest rates are at right now, by the way. Like, this is just an illustrative thing. Don't tie this to anything. I'm not saying that that's what someone's going to get when they apply. What I'm saying is, for illustrative purposes, you can see how the interest rate being 7.125, you look over on the DSCR, you see that rate is higher. That's important because that holds true because there's more risk. Um, and so then you see the income. So what we're looking at when it's a regular investment purchase is we're going to look at the income from their job. So how much money do they make? Let's say this person makes $6,000 a month. And then we're going to look at that property that they're looking to buy as an investment property. And we're going to look at how much rental income each unit's going to generate. So let's say it's 1350. We're going to then take a vacancy factor because generally not every unit is rented out every single month. There's maintenance, repairs, whatever. There's a certain vacancy factor, 25%, and you come up with a total income that can be used of about $10,050. Okay. And then what we're going to do is we're going to look at the debt. We're going to take that mortgage payment of about $5,300. We're going to look at the things on the credit report, like the car loans, the credit cards. We're going to say that they don't have a ton of those. You'd be shocked. Some people got the $1,000 a month cars there. So we'll be a little bit conservative here and a little bit not. It's only 400 in this case. Maybe they only got one or whatever. Everything's so expensive nowadays. So you end up with total debts of 5,900 bucks. And then if you did the debt to income ratio, that's important. You looked at it, that's about a 58% debt to income ratio. You are not getting approved for a conventional investment property purchase at 58%. So if we went to the right column now and we just did through the lens of DSCR, the top part's the same except the interest rate's higher. Income, from the job, we're not even looking at it. The subject, so the rental income from the units, we're looking at 1350. There's no vacancy factor they take into consideration here. They're just looking at 1350 times it by 4. You end up with total rental income of 5,400. And then you have the estimated mortgage payment, which again is higher because the interest rate's higher, of 5,880. They're not looking at the car loans. They're not looking at the credit cards because again, they're looking at through the lens of can the rental income from this property pay for the mortgage of this property, right? So they're not interested in all of that other stuff. And then you end up with a DSCR of 92%. So not one, but still can get approval. That's what I want to illustrate. Obviously, if it's above one, there's some benefits to that. But you can get approval if you remember it was 0.75 or greater. So there's an opportunity there. So I wanted to highlight that. So there is, if all the variables are pretty much the same, you have the same home at the same purchase price, the same loan amount, but a different program, they can qualify and the other one they cannot. So it can open up the realm of being able to do that. And then that individual now has an opportunity to buy that fourplex and go through the numbers and manage that and make sure obviously they have a whole bunch to consider when doing it, but they at least have the opportunity to do that with that program. So some key questions to ask. What's your intended use? This is for investment properties, right? So if you're talking to a client and you're trying to get familiar with what their goals are, be important to know like what type of home you're buying, what is it, what are you going to do with it? You going to live in it or not? If they are looking for an investment property, kind of coming up with those rent expectations early is super helpful, especially as they approach a lender and they're trying to run to see if a DSCR might work. Having like you don't have an appraisal yet, you don't know what they're going to put in the market rent. So coming up with as good of an estimate as possible, as early as possible, can be extremely helpful in moving things along. Do they have the funds for down payment? Are they wanting to be an LLC or personal? And then do they have any other prior experience buying investment properties, which just helps them really to know what they're getting themselves into sometimes and different pros and cons. So the last couple here is it's just a little toolkit. So this is a little flyer, and then it goes into a toolkit where it's just kind of highlighting some of the things in this lesson. If you want a copy of the toolkit, you can just type in the Q&A or wherever, just type toolkit or whatever, and we'll send it to you. But it's just to highlight some of the key points from this so you can like quickly glance back to what was the minimum down payment or whatever, right? Last thing, if you guys have any questions, let me know. The next class that we have coming up is August 24th. I had it in notes, but I don't know where I put the notes. So it's August 24th, I believe. I'm going off memory. August 24th
You
at
are
2
correct.
p.m. PST,
You,
Pacific time. So
mhm.
1 p.m. Alaska time. So it'll be pre-qualified versus pre-approval, right, Monica? That's the one.
Correct.
So if you want the toolkit, you can just reply toolkit. But if you want us just to sign you up, because we can give you a link to go to sign up, or if you want, you can just say class or sign up for class, and we can sign you up for the next one. That way, you'll get the reminders of it, and you'll get the recording in case you can't actually come. But yeah, if there's any questions, let me know. Let me try and stop sharing my
I'm
screen
not
here.
seeing any questions at this time, but I think it's important, like you kind of highlighted there, that this is just for investment property
Yep.
purchases. So someone not looking to purchase a primary residence. So just one thing to keep in mind, but that covered it pretty well. That
Sweet.
was awesome. We are
Good.
excited for the next class coming up. And if anybody has any DSCR questions, make sure you reach out to Jared. He is the expert on these.
Good deal. Thanks, you guys.
Have a great day.